Most people believe that becoming rich in the stock market requires extraordinary intelligence, insider connections, or the ability to predict the next big tech company before it explodes. They think wealth comes from luck or perfect timing. But after watching investors for years, I can tell you something very different. Real wealth is usually built quietly, slowly, and almost boringly. The true secret is not chasing hype or reacting to headlines. It is owning a system that compounds over time while you focus on your life. The strategy that has historically created more millionaires than almost anything else isn't flashy. It doesn't promise overnight success. Instead, it relies on discipline, patience, and the power of the American economy itself. And at the center of that system is the S&P 500, an index that represents 500 of the largest and most influential companies in the United States. Understanding how this single index works can completely change how you think about money. Hello, I'm Nate. I've been working at Plumaz Bank for the last 10 years, and through my banking experience, I've seen how money actually grows and how most people completely miss the simplest path to wealth. Subscribe, because everything I share comes from real financial exposure, and it might help you avoid years of mistakes. Let's talk about how the S&P 500 actually makes you rich. The first and most powerful force behind the S&P 500's wealth-building ability is compound interest. Historically, the index has delivered around 10% to 10.5% average annual returns when dividends are reinvested. Now, 10% might not sound life-changing at first glance, but the real magic is not in a single year. It's in what happens across decades. When you invest $10,000 and earn 10%, you grow to $11,000. The next year, you're not earning 10% on your original amount anymore. You're earning it on a larger base. That larger base keeps expanding, and each year the growth builds on top of previous growth. Over 20 to 30 years, this process becomes exponential. The curve starts slowly, almost boringly, and then it accelerates dramatically. This is why someone who starts investing at 25 can end up with significantly more wealth than someone who starts at 40, even if the second person invests more money. Time multiplies results in a way most people underestimate. The second reason the S&P 500 works so effectively is passive investing combined with low fees. Instead of trying to analyze individual stocks, predict earnings reports, or react to daily market noise, you simply buy an index fund or ETF that tracks the entire index. Instantly, you become a partial owner of 500 major companies across industries like technology, healthcare, finance, energy, and consumer goods. This level of diversification would be extremely expensive and complicated to build on your own. Because these funds are passively managed, their expense ratios are typically very low, meaning you keep more of your returns. Over decades, even small differences in fees can compound into massive differences in total wealth. High fees silently eat into compounding, while low fees allow compounding to work at full strength. In long-term investing, minimizing friction is just as important as maximizing returns. Another major advantage is dollar-cost averaging, which removes emotion from investing. Instead of trying to guess when the market is at its lowest point, you invest a fixed amount regularly, every month, every paycheck, or every quarter. When the market is high, your money buys fewer shares. When the market drops, your money buys more shares at discounted prices. Over time, this strategy averages out your cost basis and reduces the risk of investing a large sum at the wrong moment. More importantly, it protects you from your own psychology. Fear and greed are powerful forces that cause most investors to buy high and sell low. Dollar cost averaging forces discipline. It turns investing into an automatic habit instead of an emotional decision. Over long periods, this consistency can significantly smooth out volatility and strengthen overall returns. The S&P 500 also benefits from automatic rebalancing and structural evolution. The index is not frozen in time. Companies that decline, shrink, or fail to meet criteria are removed, and stronger, growing companies are added. This means the index continuously adapts to changes in the economy. Decades ago, energy and manufacturing may have dominated. Today, technology and innovation play a larger role. As the economy evolves, so does the index. By investing in it, you are effectively aligning yourself with the strongest segments of the U.S. economy without having to make manual adjustments. You are not betting on one company's survival. You are betting on the overall growth and resilience of American business. That built-in evolution makes the strategy remarkably durable over long periods. Finally, diversification significantly reduces risk while preserving growth potential. When you own 500 companies instead of one or two, the failure of a single company has minimal impact on your overall portfolio. Individual stocks can collapse due to scandals, competition, poor management, or changing consumer behavior. But an index spreads that risk across multiple sectors and industries. This reduces volatility compared to concentrated bets and increases the probability of long-term survival. However, it's important to understand the time horizon. The S&P 500 is not a get-rich-quick tool. In the short term, 1 to 3 years, it can experience significant swings and even sharp downturns. But historically, over 15 to 20 years or more, it has delivered strong positive returns. Patience is not optional here. It is the entire strategy. And of course, past performance does not guarantee future results, and all investing involves risk. But if history has shown anything, it is that disciplined, long-term participation in the S&P 500 has been one of the most reliable wealth-building strategies available to ordinary investors.